welcome to yet another edition of Taking Stock. This is the show where we take stock of the week gone by and we prepare you for the next trading week. I'm Sonia Shenoy, and as always Anuj Singhal is with me. It's been a slightly choppy week for the market, a downbeat week actually, where the Nifty and the Sensex fell about 2% for the week. And we did see a big crack come in on Friday after negative global cues where the ECB or the European Central Bank disappointed the street. But we just needed some reason to correct because the market in any case has been in a downtrend. Anuj, it's been slightly disappointing for the market. Not just was the index down 2%, but we saw a lot of heavyweights come under pressure this week.
Yes, Sonia. In fact, as you said, market needed an excuse, and on Friday the ECB was an excuse. Our market was underperforming even on days when global markets were strong, and when the global markets turned, our markets really had it weak going for them. I think two things stood out in this week, Sonia. One was that the Bank Nifty has again shown you signs of breaking down, and it's telling you that that's the preferred instrument for the bears, and that bears are in pole position as far as the Bank Nifty is concerned. The second thing that stood out was that mid-caps outperformed for the week, which could be good news if you believe that the market will make a bottom somewhere between now and the previous low of 75.50. But if at the same time the Nifty does not respect the previous low of 75.40, this mid-cap outperformance is going to actually act against the traders, because that would mean that there could be quite a bit of unraveling in some of these mid-caps. So that could be a bit of a problem point. As of now, this remains a bottom-up stock-picking market, but the overall market risk, that overall market risk of testing the previous low, that's always there. And this week, it was clearly there. And the fact that FIs are still selling, both in cash market and in index futures, is telling you that smart money believes that a breakdown is imminent for this market.
Oh yes, definitely. And there are many signs suggesting that. So let's do one thing. Let's get to guests on our show now. Joining us, we have Jain, Director Equities at IIFL Private Wealth Management, and Vinay Khattar, the Associate Director and Head of Research at Edelweiss Financial Services. Thanks for joining us, both of you. Vinay, I want to start off with you. The market has been under pressure for a while now. In fact, we've been struggling to get even to that 8,000 level on the Nifty. Do you expect more downside in the near term?
Sonia, I just would want to create a perspective. Let's look at what has happened globally in emerging market space in last, let's say, 10 to 12 months. On an average, emerging markets globally see an inflow of $22 billion per month, which in last 10 months has come down to less than $6 billion. So that's a huge amount of money flow which was happening for maybe a decade or so, which has now kind of dried up for this last 8 to 10 month period. Second, this effect is visible in the equity and currency and bond markets, and whether it is Brazil, Russia, Indonesia, Philippines. Almost most of these markets have suffered significantly, both on the currency front as well as on the equity front. Indian markets, on the other hand, have been quite insulated, so to speak. We've made a low of about 7,600, but the markets have not cracked any further. A big reason for that is a very significantly stable macro situation in India, both on the current as well as on the fiscal side, plus oil being so low and inflation under control. I think it's a very Goldilocks situation that India has gone through, because of which our markets have not suffered as much as what most of the other global the emerging economies have suffered. Now, going forward, my personal sense is that the Fed rate hike appears to be one of the biggest events which is around the corner. It appears to be a given that most likely the Fed will hike rates on 15th of December or thereabout. And if that were to happen, it will be a major event which could have an impact on the markets, as what we saw 2 years ago when there was a news that Fed was likely to raise rates. Two factors will determine whether the shock will be short-lived or it will last longer. One is a big chunk of traders or bond traders in the market today haven't seen actually rates being hiked, because the rates have been on a downward trajectory for so long that serious rate hike scenario has not been witnessed by a significant chunk of bond traders in the in US investment world. Secondly, what will be the trajectory of the rate hikes of Fed? If the Fed decides to hike rate aggressively, again that is based on that is dependent on what kind of data comes in. If that were to happen, you would see the market remaining subdued. But otherwise, once the shock passes through, our sense is it will again becomes a very good bottoms-up stock pickers market.
Okay, so this is still going to remain a bottom-up stock picking market. So we'll discuss some of your stock ideas in a bit. But before that, just a word on the problem point for the market, which is banks. Are you surprised that at every level we are seeing selling in private sector banks? On Friday also we saw a big sell-off in names like HDFC Bank, ICICI Bank, Kotak, even HDFC, the financial stock.
You see, there has been some degree of stress which is built up in the banking stocks, and part of the reason could also be because of the strengthening of the bond yields, which has shot up dramatically in last few weeks. That is one factor. Overall, the NPA scenario remains what it was. There is no clear pickup or reduction in NPA scenarios, though the build-up on NPAs have stopped now. So the non-performing asset build-up which was happening and the worsening of the numbers which was happening has clearly stopped. My personal sense is that bank NPAs will begin to improve once the economic traction improves. There are two factors which everybody is focusing on. One is recapitalization of banks by the government and banks issuing fresh equity to dilute more and raise capital. That is one factor. Second is the pickup in the economy. Now, even if you were to look at the numbers with which banks are going to be recapitalized by the government, which is closer to about 70,000-80,000 crores, and another 1.2 to 1.3 lakh crores of fresh equity being raised by banks over the next 12 to 24 months, that capital is large. But I think far more effect will come in when host of non-performing assets will become performing as the economic traction picks up. Now that is a scenario which will be hugely positive for banks.
Vinay, it's been all about individual mid-cap stocks, and you've identified a couple of very interesting stocks for us. The auto space has been in focus all week, and the stock you've picked out from there is Jamna Auto, which makes these tapered leaf and parabolic springs for commercial vehicles, which is a space that's doing quite well. What kind of trigger do you see for this stock?
So Sonia, the big call is in the CV space itself. The MHCV space has undergone through tremendous amount of stress. And if you look at what happened in last 3 to 4 years, the economic cycle was in downturn, then you had a host of mining issues, and mining is a very big consumer of trucks. And all that is now beginning to reverse. If you look at last 2-3 quarters numbers, CV cycle has picked up very, very aggressively, especially in the MHCV segment where higher tonnage vehicles are sold off. And that's one reason why you found suddenly Ashok Leyland doing significantly better than Tata Motors. Now, Jamna Auto provides spring leaves and parabolic leaves to the MHCV and the CV segment. And because the cycle was in a bad turn, Jamna Auto also went through a significant degree of stress. But the kind of stress the CV cycle saw, Jamna Auto was able to shrink its cost, manage its business better, and the number degradation was not as serious. But at the same time, they were able to bring down their cost structure in a manner that caused the break-even points to move lower. So their earlier break-even point was 7,500 metric tons of production per month, which came down by almost one-third to about 5,000 tons per month. Now, with this kind of a break-even point being reduced and the cost structure coming down, as the cycle picks up, you will see significant number upgradation for Jamna Auto. Plus, they are moving into new products. Air axles and parabolic springs and all are now contributing almost 10% of the sale. So overall, our sense is at 1,000 crore of market cap and such a big opportunity, it's relevant to remember that it's almost got 64% market share in India. And now with the GST coming in, the after sales market, which is almost 4 times in size of the OEM market, is likely to open to him, in which he's going to be focusing. So at 1,000 crore of market cap, it could be a very, very interesting bet with a 2 to 3 year view.
Okay, so that's a long-term bet coming in. But Anu, for the shorter term, if we do see this market downtrend continue, then what are the 2 or 3 stocks that you would trade either on the short or on the long side next week?
Well, if we were to look at stocks which have given a breakdown, I mean, there are quite a few because Bank Nifty itself has given a negative bias. So already all the PSU banks have given up substantially in the 2-3 trading sessions. You're seeing another at least 3 to 4% cut more on the PSU banks, even to get to support levels. Apart from that, TVS Motors is broken down, so it's close at 284. So I would say that with a stop loss, to about 300 on a rally up till 290 any day that you get, I think that will go down to about 272. Yes, the Chennai floods have contributed to the sentiment out there, but apart from that, that chart is showing weakness. Even Z, which was trading substantially over 400, is closed below that. So I would say Z with a stop loss of 407 you can look at levels of roughly about 380 out there also. So the short plays will be there. On the positive side, there are a couple of stocks which are looking interesting, where if there is a dip, you can use them to get into a chart pattern which is strong. So the whole OMC segment, whether it's IOC, BP, HP, out of which IOC chart patterns are the smartest, I think I would look at that. Probably any dip, it's closed at 432, around those 427, 426 levels with a stop loss of about 422. It's looking good for about 455. So that's a swing play. That's not a 2-3 day play. Apart from that, even something like a Century Plyboard, which is a mid cap stock, it's trading over the 200-day moving average. So I think these 194 levels are good to get into the counter.
All right, we'll do one thing. We'll take a short break on that note, but we have lots more stock chat lined up on the other side, so do stay tuned in. And in the meantime, let's listen into some market opinion that we heard through the course of the week. We'll come back.
We have been shocked by earnings downgrades. Compared to our numbers beginning of the year to now, we have seen massive downgrades. Consensus started at 20%. Now we are close to 10-11%. Of all the surprises, first quarter of the year was a negative earnings growth for BST 100. Second quarter of year, the earnings growth became even more negative. So the entire analyst community, us included, has been wrong in earnings. We are hoping that third quarter and fourth quarter lead to some sort of improvement in terms of earnings. We still think that earnings for the full year will be in double-digit range. So we are still maintaining the faith there.
I can't see too many positive figures for this market. If you look at other side, clearly you will have this Fed event, on 16th and 17th, and most people are penciling in some increase in the Fed rate. If it is followed by dovish commentary, then I think you could see some rally in EM markets. Now, really a mixed bag in terms of what the market can do over the next 3-4 months. Some positive factors, some negative. So I suspect it's going to be range bound in a reasonably narrow range for some time.